Happy Valentine's Day. It is February 14th, 2026. And while most people are probably scrambling for dinner
We're
reservations,
doing something a little less romantic.
a lot less romantic, we are looking at the very surprising intersection of love and tax law.
It's not the most obvious pairing, I'll give you that. But it's so practical. We're digging into a guide that focuses on regulations from the SAT, that's the Servicio de Administración Tributaria in Mexico.
And the big question is, can you write off romance?
Yeah. Or at least which parts.
Because love is expensive, let's be honest. So our mission for this deep dive is to figure out if any of those grand gestures can, double as smart tax strategies.
Exactly. We're trying to draw a line between a deductible business expense and just, well, an expensive gift.
And the source material starts with this kind of dramatic concept, the eye of the tax man.
It sounds intense, but it's real. The SAT actually uses algorithms to monitor spending on specific dates, like today.
Right. The guide says on high-spend holidays, they ramp up vigilance.
They're basically cross-referencing your credit card activity with your declared income. So if you report earning, say, 10,000 pesos a month,
But you go out and swipe your card for a 50,000 peso necklace today.
you've just triggered what they call a fiscal discrepancy, a big red flag.
Which brings us to the cash trap. I think a lot of people assume that if you just pay in cash, you stay off the radar.
And that's actually the other way around. It's a huge mistake. You run into two major problems.
Okay, what's the first one?
First, there's a hard rule. Any cash payment over 2,000 Mexican pesos is just automatically non-deductible, full stop,
So you lose the deduction right away.
instantly. And the second problem is maybe even worse. If you get audited, you now have to prove where that cash came from.
And without a bank transfer or a card statement.
The SAT just assumes it's unreported income. So to protect yourself, you really have to use electronic payments. It creates that all-important financial trail.
Okay, so use the card, leave a trail. Got it. Now let's pivot to the corporate world. What if I want to show my team some love today? Is that corporate self-love deductible?
Surprisingly, yes. This is actually the sweet spot. Under the income tax law, the LISR, gifts for your own employees fall under a concept called prevision social.
Social welfare.
Yeah.
I usually think of, health insurance or pensions.
Right, but it's broader than that. It includes things that improve the work environment. So food for a little gathering, a convivio, or small material gifts, even decorations. They're all deductible.
Okay, but there has to be a catch.
Of course, you need the digital invoice, the CFDI, and you must have a record of who received the gift. You have to prove those chocolates were for the team and didn't just go home with you.
That makes sense. Keep a list. But what about clients? That's where it gets tricky, right?
Oh, yeah. This is where most businesses get it wrong. Article 32 of the law makes gifts to clients much harder to deduct.
So how does that work?
A client gift has to pass two tests: relevance and generality.
Okay, relevance, that
No.
sounds subjective.
It is. The law looks at your main business. If you're a florist, giving a client a rose is a sample of your work. That's deductible.
But if I'm an accountant?
And you give a client a bottle of wine. The SAT will argue that wine has nothing to do with accounting services. It fails the relevance test.
That is incredibly strict. And the second test, generality, sounds even tougher.
It's the real deal breaker. Generality means the gift can't be a special favor. It has to be offered to all of your clients as part of a general promotion.
Wait, all of them? Like a 2-for-1 deal or something?
Exactly. You can't just decide to give a gift to your best client. In the eyes of the taxman, that's just a personal, non-deductible expense.
So I can't play favorites. I can't reward my top 1% of clients.
Not if you want the tax deduction, no. It creates this weird paradox where the law basically incentivizes mass marketing over building deep personal business relationships.
So to recap, for everyone listening, use electronic payments. Always.
Always, to avoid those discrepancies.
Employee gifts are pretty safe, as long as you document them under Prevision Social.
Yep. But client gifts are, they're almost certainly not deductible unless it's a broad promotion for everybody.
And just to be clear for individuals out there, your romantic dinner tonight.
Never deductible. That's just the cost of doing business with your heart.
Harsh but true. I guess financial self-love is the only thing that's truly deductible today.
It's the only guaranteed return on investment.
And I want to leave you with a final thought on that generality rule for clients. It raises a really interesting question. If the law forces you to give a gift to every client to get a tax break, does that system actually help small businesses grow? Or does it just push them into generic marketing because that's the only thing the tax code rewards? Something to think about over those very non-deductible chocolates.